Hello and welcome back. This is our series of legal English as it relates to income taxes, taxes generally, and business. This will be the second part of our video series. Our first one talked about income in a lot of different ways, and I recommend that you watch it before you get into this one. That being said, this is the really good one that tells us how we can start to reduce our income, at least as it works with the IRS or your tax authority. This is what we can do to limit what we have to pay at the end of the year, and in essence, that's what we're really after. My name is Jeff Keiser. I'm a lawyer. I'm a legal English teacher. I've worked on big cases in the US. I've worked on small cases in lots of places around the world. I am a legal English nerd, some would say, and I'm able to help you work English, use English in your careers to make your practice better, to become better lawyers. Here in the world of tax, this can get a little bit more complicated, but just because we're dealing with numbers more than words, but it's still important to use legal English throughout this entire process. How we craft our arguments, how we state what values, what deductions, what income we're talking about. English still is the language that we need to focus on, especially if we're talking about English-speaking countries. So taxes. Like I said last time, this really is the the one topic that nobody likes to talk about. Nobody likes to pay taxes. If you do, I think you're one of the weird ones. I sure don't, but it's something that we've got to deal with on a regular basis. So we want to pay as little taxes as we can, and by using these deductions and credits, I think that we can minimize the tax we pay. So in this video, we're going to talk about a few things. First off, why do we want to lower our income? I mean, income is good, right? Why do we want to make it smaller? We're also going to talk about the difference between deductions and credits. They are two very important concepts in tax law, and yet they're slightly different. People can get confused about the distinction sometimes, but we'll talk about that later. Finally, we're going to talk about something that's really important, at least with the United States tax law, and that is the Foreign Earned Income Credit. It's a way that we can help people like myself, especially an American that lives outside of the United States, minimize the taxes I have to pay. If you'll remember from last time, the United States is one country, really just the only country, that taxes based on citizenship, meaning that my income from wherever I earn it is taxable in the United States. So let's start with a little bit of a discussion about the difference between a credit and a deduction. And these both are used to minimize the taxes we pay. Starting with a deduction, this is something that will lower the income that you have to report. In the United States, for example, if you have children or other dependents, they will lower your tax, your income. You get a deduction from your earned income. So if you make $100,000 in 1 year, but you have 5 children, you might be able to reduce that to $85,000 or $90,000. Obviously, the lower your income is, when you multiply that by a percentage, the lower your taxes will be. On the other hand, we have what they call credits. And this is something that will take your tax liability. Let's say that I earn $100,000 and my marginal tax rate works out to be 20%. That means I'd pay $20,000 in taxes. A credit will cut from that $20,000 in tax liability. So let's say there's a credit of $5,000 because I opened a new business. That means that my income would remain the same, my rate would remain the same, but my tax due would be lower by $5,000 in that hypothetical. And let me just say that I'm making those numbers up. There's no magical $5,000 credit out there that I'm aware of anyway, but that's just for an example. Just like last time, we're going to go through a few vocabulary terms that will help us work through the concepts of deductions and credits. One is the benefit test. And this is what the tax authorities will look at when it comes to your tax liability, your income. And what it means is that when we think about whether a company can deduct a certain amount as an expense, payments related to related companies, say you have a parent company with several subsidiaries, the expenses incurred by that related company in providing services to the parent company or to other subsidiaries or affiliate groups, you cannot deduct things more than once. And you cannot make a deduction for your subsidiary unless a real benefit has been conferred on the company claiming the deduction. This is a very complex thing to think about, but it's something that we always have to consider is who receives the benefit of a deduction. And they're the party that can make that deduction. A carryover. This is a system where deductions or credits from one year can be carried over into the next year. This involves a great deal of business strategy, and so it may or may not apply to you. One year you may make a very little amount of income, but have a bunch of deductions or credits that you could use. You might be able to push them to the next year in a way that you can hopefully make more income in that second year and use those deductions and credits in a more efficient way. A deduction, just like we talked about, this is something that is subtracted from your taxable income. Having children is a really great one when it comes to your personal taxes. But there are others that work in the corporate tax realm, and we'll talk about those just a little bit later. Itemized deductions. Now, I honestly don't know if all countries operate this way, but in the United States, we are given the choice. We can have what they call the standard deduction, and it changes every year. It's $12,600, at least it was last year, I believe. And that's something where we do not need to specify any limitations, any specifics. An itemized deduction, on the other hand, is where we will have a list of special deductions that hopefully you would never want to itemize your deductions if they're lower than the standard deduction. But if they're higher, you'll have to say that I get a deduction for having children. I get a deduction for higher education interest on my loans. There's a long list of these deductions. And if you're making a lot of money or you're spending a lot of money sometimes, itemized deductions are the way to go. Wear and tear is an interesting concept when it comes to amortization. These are things that can be deducted. These are declines in value through the ordinary use of an asset. So let's say you buy a $15,000 top-of-the-line copier for your office. You won't be able to deduct that all in one year. You'll have to amortize that year after year. And wear and tear is a part of that amortization calculation. Finally, we'll talk about rebates, which are the same as a credit. Some countries call a credit a rebate, and others call a rebate a credit. They are synonymous with one another. And that's all we have for our vocabulary in this section. It's a little lighter than last one, but I think that these are terms that are good to know when we're talking about credits and deductions as they relate to income taxes. So, marginal tax rates. This is a little bit of a complicated thing to explain, but in the US, we have 7 different tax rates, ranging from 10% to 37%. Now, these are all based on your income. So if you make $1 million a year, you'll be in that 37% tax bracket. If you make $10,000 a year, you'll be at the lower end, the 10,000 or the 10% bracket. Now, when I say marginal tax rates, the better way to think about it is that your first 10,000 of income will be taxed at 10%. Then your next 10% will be taxed at 12%, and so on and so on. Again, these are not the official break-off points for these brackets, just a hypothetical. So if you make $1 million a year and you're in that 37% bracket, that does not mean that you'll pay $370,000 in taxes. It's more complicated than that. It will be somehow lower. But every dollar you make over that threshold between 35 and 37 will be taxed at that higher rate. So it's a little bit complicated. I hope you understand. But it's these brackets only consider these sections of income, these segments of income. And the higher you go, the higher you'll pay. This is what they call a progressive tax system, where it's not the same percentage for everyone, or no matter how much they make. It is higher for higher income earners. So in Japan, this is how the marginal tax rate works. I'll let you just take a quick look at this chart, and you can see that your highest tax rate is 45%, much higher than the United States. But at the same time, your lower marginal tax rate is lower than the lowest United States. Each country has developed their own system, their own brackets, their own amounts and their thresholds. But what's important to note is that if you were to make over 40 million yen a year, first off, congratulations. Second off, you will not pay 45% on that full amount. You'll only pay that 40% on earnings above that 40 million yen threshold. Deductions. We're going to try to focus on corporate tax deductions here. And the easiest thing to consider is that we can deduct from our income certain ordinary business expenditures. Okay? So things like payroll, your employees and salaries, their health benefits, tuition reimbursement, all those benefits that employees get are a deduction for the corporation. Same thing goes with things like insurance. When a corporation buys insurance, it takes away from your income, right? It's not going to end up in your pocket at the end of the year. So we can deduct that from income. Travel expenses, bad debts, meaning that we made a loan and the person we loaned the money to has gone bankrupt or has disappeared somehow. Those can all be deducted from our income. If you're a tax attorney, I'm sure you know that any monies that a corporation spends to prepare their taxes every year or for legal services, these are also major deductions in the world of corporate law. So the list of important tax deductions in the corporate world are longer than we have time to really touch. There are thousands of potential deductions, at least in the US, and I assume around the world. But some of the big ones that we need to think of is depreciation. Like we talked about, if you bought an expensive copying machine and we spend $15,000 on it, after 1 year, it's depreciated a certain amount. Maybe it's only worth $10,000 per year, or that in the second year, excuse me. When that happens, that $5,000 is lost income. And so that's the kind of thing that we can deduct. Amortization, if we buy a major asset and a copier may qualify, we may break that out over 3 or 5 years to have a tax deduction over the long term. Employee benefits, pensions, health insurance, all of the things that work into a benefit plan are also a major tax deduction for corporations. And one that people don't think about that much are net operating losses. If your corporation has lost money that is also something that we can deduct as an expense as we do our income taxes. So we had this hypothetical last time, I hope you remember, where the XYZ Corporation earned a profit of $50 million in 2022, and their corporate tax rate was 21%. That would make their tax liability $10.5 million. But now, if we can figure out $10 million in deductions, whether it's for employee benefits or amortization and depreciation or anything else, that reduces our taxable income to $40 million. Still a good year if you ask me. But the important thing is that reduces our tax liability by more than $2 million. So in any business, $2 million goes a long way. And deductions are one thing that all corporations are looking for, and if you have a good strategy, can be used to really lower your tax burden. Credits are similar in that they reduce your tax burden, but these are things that come off the bottom, the end. So, like we were saying, if there's a $10.5 million tax liability, right? And we can find a $1 million credit for some kind of governmental program. That doesn't reduce our income. That's not a deduction, but instead it's a credit. And that means that we can simply take that $1 million off of our tax burden and lower it. It helps lower our how should we say, our effective tax rate. I know we cover that as a definition in one of the next videos, but so I won't touch on it too much here. But this distinction between credits and deductions is very important, and it's something that really is something that a smart accounting lawyer will know all about. So some of the credits that we see in the United States are things like a foreign tax credit. And that's where if we invest in a foreign company, maybe we have a factory in China or Vietnam, then we can take a credit on our own taxes. There are certain employment credits that are important. By hiring veterans or handicapped people, we can sometimes put a credit on our tax liability. Some industries, like pharmaceuticals, are able to get credits for their research and their other development of the drugs that they will hopefully sell to the public at a fair price. Tax credits generally are designed to further social policies, to make the world a better place. It's an incentive to hire someone that you might not otherwise hire, or to pursue research in a field that other people aren't going. So there's usually a social component when we're talking about credits. Again, there are hundreds, if not thousands, of these available, and they all depend on how your corporation is set up, what industry you're in, and what kind of money you're spending. But they're absolutely one of the most important things when we're talking about corporate law. And that's all I have right now for deductions and credits. And I know I said this was the important one, and it really is. But next time we're going to talk about some other lesser known ways that we can reduce our tax liability. Now, I'll leave you with this one thought. Tax avoidance is fine. It's perfectly legal. But we can't lie and we can't cheat. We have to follow the rules to get where we want to be. So until next time, stay tuned. We'll talk about some fun ways to lower our tax liabilities. Thanks again for showing up, and I hope everybody has a great day.